The Nosso Equity Fund performed well during the second quarter of the year, returning 1.9% against the JSE Cap Swix, which returned 0.6% for the year. Overall, global equities performed well during the quarter, with the MSCI World Index returning 7.9%. There seems to be a good correlation over the last 6 months between the pace of vaccine rollout and the performance of equity markets. And in general, we've seen developed markets outperform emerging markets. Similarly, equity market performance reflects this. The S&P returned 15% year to date, the FTSE 100 12%, and lagging this has been the MSCI emerging market returning 7.6%. Commodity prices have also been robust as economic data has been supportive. In particular, we're seeing strong coal prices, oil prices, and strong price dynamics for industrial metals. Against this, precious metals have been lagging, in particular platinum and rhodium, which have detracted respectively 10 and 24% during the quarter. The local equity market, as I said, increased by 0.6%, and despite being soft on a relative basis against other emerging markets, has done very well over the last 6 months, and in fact is 10th out of a subset of 32 emerging markets year to date. From a sector perspective, financial and industrials in the local market did particularly well, excluding Naspers, and resources didn't do well, as I said, lagged by precious metals, and in particular PGM miners. Sectors that actually stood out were personal goods, beverages, retailers, and REITs, which did very well during the quarter. The fund benefited from a number of dynamics, both stock-specific issues as well as sector allocation dynamics. From a stock selection perspective, the conviction call in a number of stocks benefited the fund, including Dis-Chem, Distal, Investec, and Life Healthcare. From a sector perspective, being underweight PGM and gold miners helped the fund. Overall, the fund is well constructed and diversified. We can maintain conviction call in the industrial space and maintain an underweight position to resources. We see a number of opportunities in the buy list, and this has allowed us to take a more diversified bet instead of taking idiosyncratic single stock specific risk. We still remain positive for the rest of the year with regards to the outlook of local equity.